All right. Good morning, everybody. Welcome. I am Don Kaufman. You are watching Inflection Point Spreads, an Ultima Premium selling strategy. As we get kicked off here on today's class, just note Ultima Premium selling is kind of a prerequisite. You're about to get thrown in the deep end of the pool. That's all I'm going to say. All the other informalities are already covered. If you have questions, well, we'll be able to answer those questions at a very formal Q&A session. I'll try to answer some of the questions as we cruise along today. But without further ado, let's actually jump forward to none other than Inflection Point Spreads. Obviously, it's a copyright disclaimer. This is ours. This is not yours. If you need to get a hold of us, support at theotrade.com. By the way, we're located in the Virgin Islands. All right. Nice. It's nice this time of year there. It's nice all times of the year there. All right. A little bit of a risk disclosure. We're not financial advisors nor broker dealer. No soliciting, no recording, no photography, and especially do not feed the monkeys. Okay. I put it on zoo rules for today. All right, onward and upward from here. This is a little bit about me. Obviously, I'm the co-founder and lead instructor here at TheoTrade. If you've been here quite some time, well, we've had quite a number of classes. This, though, specifically is going to cover a tremendous amount about premium selling, which I'm going to discuss here momentarily. I've had about a 24-year trading career. I have 21 years experience specifically on Thinkorswim, ran the education for both Thinkorswim and TD Ameritrade for approximately 15 years. All right, Inflection Point Spreads curriculum. So this is somewhat of what we are going to cover today. And again, just briefly taking you through this. You're going to learn to sell premium and hedge that risk in one transaction. Now, for those of you that have been at TheoTrade for months, years, you've actually seen me using this particular strategy time and again. I mean, I've had to use it because there's not an easy go-to hedge at this present time, which is something that we'll explain in a little bit more depth throughout the course of today's class. We're going to learn how to create a high probability position that generate monthly returns regardless of account size. We'll talk about account size specifically today as well. Even small accounts, you have $2,000 in a margin account, you can do this. Discover how to hedge existing positions, even the most extreme environments. One of the most important aspects, and again, I implore you to understand out of today's session, what we're doing today, it's not just about, okay, today or what's going to work in the future. You need this strategy, okay, to mitigate risk in extreme environments, period. Like there's, full stop on that. You're going to need this because volatility, it's not going to calm down. It's not going to calm down for quite a considerable period of time. We're going to cover detailed criteria for inflection point spreads, keeping risk at a minimum. You're going to learn how to analyze the inflection point spread. I am going to torture you with analytics today. I love that stuff. You're never going to be caught off guard by risk, though. We're actually going to get a good feel for it. And you're going to find how many inflection point spreads. You're going to see this IPS stands for inflection point spreads. How many you can safely allocate literally for any account size. All right, so where to begin? Okay, where to begin? Know your Ultima premium selling techniques. So inflection point spreads, okay? This is designed to build on our knowledge, okay, of selling premium using the Ultima criteria. In fact, I'm even going to show you some of the Ultima criteria. Again, inflection point spreads is Ultima. In fact, there was another course we also did, the Income Accelerator course. The Income Accelerator course is also Ultima. So there's an entire series of classes, obviously, that we're hosting specifically on Ultima. Why? It's what works. I mean, look at the track record that we've had specifically with Ultima recently, okay? It has been gold, Jerry, just gold. So we're going to build on your knowledge of premium selling, okay? The unique difference, though, with an inflection point spread, it allows us to sell premium and hedge at the same time. So here I am selling premium, hedge on at the exact same time. We don't have to wait for the VIX to be at a certain level. We don't have to wait for risk twist spreads, which haven't really worked, okay? The inflection point like spread trades are intended to complement an Ultima premium selling portfolio, and premium sold, okay, shall be closed using Ultima criteria, which we're going to cover a little bit. Now, just a brief review. Now, one of the things that I had mentioned leading up, of course, to this class here on inflection point spreads is that I wanted everybody to review the Ultima Premium selling criteria. So the Ultima class, okay, is absolutely unequivocally pertinent to today's market environment. So what's changed? Hedging. Hedging is tough to do right now in a wild environment. So when we're talking about this criteria, just cliff note version of this, okay? Select an ETF. Well, yeah, you can have an ETF. You could use the spiders and the QQQ and the IWM, the ES, the MES. MES is the micros. We love the micros, okay? Anyway, you select one of these products. The underlying needs to have massive liquidity, tight spreads. Check that the 30-day implied volatility is under 90%, okay? Why do I do that? Because I don't want you involved in a full-blown crash situation, okay, in some equity product called like GameStop or, again, people get themselves into a lot of trouble in a lot of different ways. So a lot of the criteria that we devise here, okay, is to eliminate you, okay, from basically, shooting yourself in the foot a multitude of times. Please, okay, understand that criteria is a direct reflection, okay, to limit the scope of the world that you live in. That's by design. That's what criteria is. It's like a sand sifter, okay? And you start with a big pile of crap. You know what you're left with? 5 or 6 products that you're going to want to trade. And a lot of you're like, this is so boring. Listen, do you want it to be boring? You want to make money, okay? Because making money in this business can be very boring. Anyway, so get that implied volatility, 30-day IV under 90%. Okay. And again, the 30-day implied volatility should be under 90%, not the 90-day, not the 10-day, the 30-day. Okay. Expiration selection, sell premium 42 to 115 days out, not 180 days, not leaps. We're not selling leaps. You don't go out more than about 115 days. Call option, you're going to sell between a 7 to 11 delta. The put option, you're going to sell between a 6 and 10 delta. Allocate small size, scatter inventory, splat. You got a splat inventory, minimum of 3 expiration cycles. Work your orders, people. Sell stuff at mid price. It's a good idea. Now, as that review, okay, hits, a lot of you have actually been with us for some time and probably have actually followed some of this criteria and done extremely well, especially in the midst of even some of the heavier volatility that we've seen. So why are we going in, okay, to something new? This is what I say, game on, okay? We're going to have a strategy talk. Part 1 is our strategy talk, getting to know inflection point spreads. Sounds like warm and fuzzy, getting to know you. Yeah, you're going to go on this is a first date. It's a blind date with an inflection point spread. I hope you like the way it comes out. Okay, I'm going to get myself in trouble over here early on. Anyway, game on. So why are we looking at inflection point spreads? By the way, here, the camera on, you can visualize the caffeination. Okay, there's going to be a lot of that today. It's been a long couple of days. We put these classes together. Let me tell you something. Okay, finding some of the pictures, like the life preserver that goes in here. There's a lot of time and effort that goes into that, people. So why inflection point spreads? Okay. Listen, we want the capability to execute new premium selling opportunities. But the issue is that we're in the midst of some pretty big boy volatility. I mean, as we are shooting this, okay, inflection point spread class, and people of the future will be watching this. In all honesty, people will be watching this 2-3 years from now. But in the midst of this particular class, okay, we're in a 30+ VIX. All right. And a lot of people haven't necessarily traded in the 30+ VIX, but we've been consistently, north of about a 25 volatility. Okay. Volatility is too high for routine hedges. Like what we've gone to, like the go-to hedges, there has been no lull in volatility. It just keeps coming. I mean, this is like, if you have ever been out in the ocean, okay, you kind of paddle out there and there's usually lulls in between sets. There's no lull. There's nothing. You're just basically going. And you can't function in this business without those hedges, right? Without hedges, you can't open new premium selling because, well, then you just get killed at some point. Markets will collapse and you're going to get killed. So inflection point spreads, IPS to the rescue. So we've got issues, people. Got a lot of issues with you people, all right? We got issues with hedging. And you got to understand that's the key. Yep, we have issues. Okay. With getting a hedge on in the midst of high volatility, the go-to hedges, as I was saying, of ultimate premium selling strategy are not presently viable due to high volatility and just a wild skew. Interestingly enough, skew's gone wild, even in the midst of this volatility. Again, this is really interesting because skew is back up, okay, just in the last few days. We're like, okay, not only do you have high impact volatility right now, but you got people hedging it. So price your hedges in the present market conditions, and there's a no-go. And what do I mean by that, price your hedges? Well, let me explain a little bit. Hedging in heavy volatility is a serious problem. Can you buy a downside hedge when the markets are tanking? And the answer to that is no, not for a decent price. The hedges, the go-to hedges that we use, okay? So when you're looking for this and you're looking to buy those downside hedges, okay? I cannot stress enough, right? Cannot stress enough that they're not at good pricing. Like for instance, and I'm actually going to give you the hedges from the original Ultima class. What are the hedges from the original Ultima class? For example, okay, example number one, like a risk twist spread. Okay, risk twist, this is my baby, man. The risk twist spread, no joke. Okay, that is not something that I just built for like Theo trade. That's something I actually used, and it had saved me. Okay, saved me a huge amount of capital back in 2007. That's where the real genesis of the risk twist, okay? But the issue with risk twist right now is that volatility in back month options is extreme relative to risk. What the risk twist does is it looks to buy, okay, back month volatility when volatility is down. The only problem is volatility isn't down. Risk twist, what's wrong with it right now? Won't work, okay? Risk twist is out. Gamma irons, it's out. IV ranks, they're too high. Skew or having a negative impact. It's not going to happen. VIX volatility spreads, really? Do you want to buy like a 30 VIX? Okay. Oh, the VIX is at 30. I really got to buy that. Overall, VIX has sustained elevated levels and provides a little opportunity to hedge. Like the VIX, again, it's not easy to hedge in the midst of heavy volatility. So, okay, who loves selling volatility? All right, Tasmanian Devil does. Selling premium is born through volatility. Like, can you sell premium in lower volatility? Yes, you can. Yes, you can, but selling premium is just idealistic in heavy volatility. Volatility brought premium selling into this world, okay? But hedging looks to prevent, okay, that volatility from taking you out. We shall never abandon our premium sale. We shall never abandon our premium sale. By the way, this is, I don't know, that's kind of how I think of like volatility in my head, okay? The Tasmanian Devil, I don't know, just like it's a monster. It's a monster, okay? We need a hedge. We need a hedge to sell premium naked. And again, we're gonna sell premium naked. Whether you like it or not, we're selling premium naked, but we're going to reduce the risk. We're gonna mitigate some of that exposure. You came into this trading world naked, but now you need a hedge. Selling naked puts with no hedge, okay? Think about what that is. Like, again, no one questions the naked pig. By the way, I couldn't think of a good analogy for this. So for some reason, Porky Pig came up. And if you think about this, and again, these pictures have a lot of meaning, people. Okay, if you think about this, nobody ever questions the fact that the pig is totally buck naked. Nobody ever questions the pig until, of course, the pig gets served up for dinner. Okay, but what we need, yeah, I know that analogy was out there. It was out there. Put an apple in his mouth. It's all good. We need a definitive downside hedge in order to sell out of the money naked puts. However, we need to make the cost of the hedge reasonable, even in the midst of volatility. So you got to have a reasonable cost to the hedge. We okay? Okay to go. All right. I do like the Looney Tunes characters. It's good stuff. All right. You have to play on my level. Enter the inflection point spread. Dun, dun, dun. It's supposed to be like music in the background right now. So the inflection point spread, okay, uses the options implied volatility skew to benefit, okay, by dramatically reducing the cost of downside put protection. You're like, what? Don't worry. That's what we're doing right now. what we intend to do in just the next 5 to 10 minutes in this whole part one is just project upon you strategy. Okay. What's the basis of what we're doing? What structurally is this going to look like? That's what I'm going to provide you in the next 5 to 10 minutes. Right. So basically, what the inflection point spread is doing, we found a way to get a cheaper hedge on by using skew. But the irony is, okay, that the same implied volatility skew that creates this hedge, that same skew is being used to sell premium very, very effectively, way out of the money using Ultima. So I had to find a way to twist skew in one aspect in our favor to hedge, and in the other aspect, I had to twist skew, okay, to be able to sell premium. But first, let us view the inflection point spread structure, and then we're going to dive into implied volatility, skew, and maybe even U. So let's designate what the structure, okay, of this beast tends to amount to, right? And again, I stress to you, I'm gonna kind of walk you through just a little bit about this. Okay, so let's assume, and again, I'm going to take you through a little bit of let's assume that we're using a product like spiders. So where are the spiders presently trading? Okay, now throughout the course of this class, we will bring up a platform or two from time to time. We'll use Thinkorswim, we'll use a little tasty, okay? But generally speaking, I'll talk about spiders, we'll talk about like the micros in here, either or, okay, are completely fine. So in kind of putting this in context here, what I'm going to do is, here are the spiders. So let's assume that we're going to trade SPY, and the SPY is trading right at 430. Okay, what is the structure of the trade? Okay, first and foremost, what do we want to do? We want to sell premium. Okay, we want to sell out of the money. Okay, options. Want to sell out of the money options. We can go way out here. Okay, way out here in the nosebleed seats. Let's get crazy. Let's get crazy. Let's say we're going to actually sell a June 310 put. Okay, we're going to sell a June 310 put, and that thing is going to be trading for $2. $2. A June 310 put, okay, and it's going to be trading for $2. Now, boom, that is it, baby. That's the trade. That's all I've done. The risk, though, that you take on is this. If we just sold the June 310 put and this market tanks, it doesn't even have to get anywhere near 310. And what would happen to the price? Okay, what would happen to the price? Okay, it would explode of the put. You know, the volatility jumps to like 60% in VIX, and you'd be like, oh, I can't take it anymore. Right? So what is the inflection point spread? We're not going to go out there and just sell completely and utterly naked. Okay, we're not going to do that. So what we are going to do is we're going to use what is termed an inside put spread hedge. Okay, that inside hedge is going to be laid somewhere right in this neighborhood. And when I say right in this neighborhood, we'll turn around, for instance, and buy, and let's just throw out a number here. Okay, we'll buy a 410 put and turn around then and sell. Okay, 400 put. All right, that entire spread, oh, let's say it'll cost me $1.70. That's a debit. Now, okay, what we have here is, okay, the structure of the most simple form of an inflection point spread. Allow me to explain now, kind of in context of what the design of the trade happens to be. A lot of people look at this and they say, so on one hand, you're paying $1.70, right? That's the debit. And on the other hand, you're selling premium and you're collecting $2, okay? And that's a credit. Well, lo and behold, I'm not making very much, Don. Okay, time out. That's actually not the intention of the trade. The intention of the trade is that, you know, this okay, this one spread, that one spread is capable of reducing risk of a lot more than just one out of the money put, okay? It is absolutely capable of reducing risk of a lot more than just one out of the money put. So I stress to you, don't panic about the fact that it's only being put on for a 30-cent credit. I'm not really making a lot of money, because what we can then do is we could come back later and we can layer other inventory in here. I could sell, for instance, the 320 puts. We will cover this today. We will cover this. So we're going to layer more inventory. But what's critical to understand is the structure, okay, of the initial trade. Okay, the initial, what I call a come out trade. When I say that it's the come out trade, assume right now, seriously, assume right now you have nothing on. Markets start tanking today. Let's say the markets are just like they're coming down hard today. Most of the time when markets are coming down hard, you can't get a premium sell off. You can't do it. And the reason you can't do it, what are you going to do? You're just going to go out there, I'm going to sell puts naked in the middle of a crash. Okay. That is not going to look good. You ain't going to look good in the morning. Okay. Waking up next to the fact that you just sold puts in the middle of a crash, because all hell could break loose the next day. So what we do, okay, is with one arm, we're buying a hedge, and with the other arm, okay, we're actually selling premium. But what's so cool about the hedge is what we term an intrinsic value hedge. What does an intrinsic value hedge mean? It means, okay, that you're going to be a little bit out of the money with this hedge. Okay, I'm actually going to give you the criteria for the hedge. The hedge is going to be around the 30 delta. Do you know what a 30 delta means? A 30 delta means there's approximately a 70% chance the hedge is actually going to expire out of the money. Think about that. Okay, the hedge is out of the money, but the premium you're selling is way further out of the money. All right, why? Because if you put this trade on properly, okay, even if we crash, the first move, bam, hits us, the first move is going to come right into your hedge. In fact, if you figure out mathematically the first move in the market, jump, okay, it'll actually give you the intrinsic value of the hedge. What's the intrinsic value? That's a $10 wide spread. What's the most you can make in a $10 wide spread? You can't make more than 10 bucks in a $10 wide spread. That $10 is there. Boom, that's it, okay? And it covered a huge amount of the risk, okay, of this out of the money put. Now there's a reason, okay, that we call this an inflection point spread, okay? This right here, the hedge, is actually done in the very short term. This, saving the best, okay, is going to be like a 30-day hedge against, you're like, oh, okay, so this is 30-day, and out here is 110-day, and you go, but the hedge is only going to last 30 days, and I've sold premium for 110 days. What am I going to do? Okay, you're going to do another one and another one. The inflection point spread actually helps you layer positions on over time and price. It's kind of a cool little trade, but in the initial burst move to the downside, it's going to cover you. So why do I call it an inflection point spread? As you will see in the risk graph, okay, when you initially put this trade structure on, even if the market crashes, there's actually an inflection point, a crossover point, where a down move in the market can actually make you money. Now think about that, okay? You're out here selling this crap naked. Market comes screaming down. The $10 you make, all right? The $10 you make right here can actually outweigh what you're losing, the loss over here. And it's called an inflection point spread because there's a crossover between profit and loss. You will see that today. All I want you to understand, there's a lot going on the screen. All I want you to understand at this present time, okay, don't worry about the time frame, don't worry about anything other than the fact, okay, that we are using an intrinsic value hedge, very short duration, okay, to hedge a longer duration put sale. We okay at that point? With that, all right? Now, we are showing you the full Monty, all right? So this is very representative of a real, okay, hedge at this present time. And I just splatted it all on there at one time, okay? And I'm just going to take you through some of the logic. So once again, Stock is trading basically at 430. Now this could be SPY, it could be stock, it could be an ETF, it could be, you know, an index, put another zero on it, whatever does it for you. Stock's trading at 430, okay? We're buying like a March hedge. Now I'm actually putting some time frame to it, okay? We're buying a March hedge. Maybe it's the end of March. Maybe it's the end of March. Maybe this is precisely a 30-day hedge. And then I'm selling a May put. The whole thing is put on for a net credit of 50 cents, okay? That's it. That's what you put on. But you reminder, okay? You have the ability to sell more later. As I said, in the criteria, we will cover that, okay? We will cover that. We will cover ratios. How many spreads do I buy versus what do I sell? Do not get ahead of yourself. All you need to comprehend at this point is trade structure. Okay, and that's really important to me that you understand structurally what we're trying to accomplish. Okay, the bottom line with a trade like this, okay, is you realize here we are at 430. How big of a drop do we need to get below 400? Okay, you need about a 30-point drop. Okay, so about a 30-point drop. See, here's the thing that you need to rationalize when putting this trade on, okay? What are some of the categorically biggest moves that you've seen in markets, okay? If the market moves 7% down, they do a limit down, okay? If we move an additional 6% for the total of 13%, okay, at that point, they will lock markets up. By the way, they can even take appropriate, you know, actions to shut markets down, okay? This hedge is appropriately positioned for actually a limit down event. In every case, in every way, shape, or form, that hedge is designed for even one of the most extreme environments, which would be what we term a limit down event, meaning that you must pass through the hedge. There's a reason that this is a 30-day hedge. And that's one that's a big question. Everybody go, why do you use 30 days for the hedge? We'll talk about that in depth, but I want you to understand in context why I actually do use it before we get there. It's imperative that we use a shorter duration hedge because the options, okay, move more rapidly. They have much more sensitivity to gamma exposure. We want, okay, the gamma exposure. We want full, what we term intrinsic value, meaning that if we actually come crashing down, we want to make the $10 here pretty much right when we get to about 395, maybe 390. If the market crashes down to 390, that's a long way away from 320. We're going to make our $10. And by making the $10, it gives us and promotes the opportunity for us to be able to bail out of the spread. It's kind of a cool way to hedge risk. And in light of everything that's, you know, going on in markets, all the volatility, you know, hey, listen, this is what you're going to need to do. So we're going to cover now why it kind of works. Now, this is two components, okay, comprise the inflection point spread. Now, I am showing you this as two separate orders, okay? I am showing you this inflection point spread here on Thinkorswim as two separate orders, okay? I am showing it to you on Tasty as two separate orders, okay? What's imperative though to understand, if you trade these, okay, and we will cover this as well, but if you trade this in equity products, watch, we're gonna come in here to the spiders. Let's close up this left side bar. Don't worry about the speed of which I put this together. Who cares the speed of which I can put it together? It's important that you can put it together, okay? The first trade that we're gonna do in here, let's pull up Delta. The first trade we're actually gonna pull, okay, in this inflection point spread, it's gonna be right at 30 days. Don't worry about the criteria yet. We're gonna get there, right? We're gonna go right here to the 416s. We're gonna buy the 416s. We're gonna sell the 406s, exactly a $10 wide spread. Look, it's trading for 210, okay? That's fine. Okay, simultaneously, that means at the same time. If you are looking out here, I'll go all the way out to the June. I'm going to go right to a 6 delta put. Okay, delta, 6 delta put. Let's go for it. Let's do this. Okay, and oh, you know what? Here's the 410s. This is like almost the exact same trade that I brought up there. Fictitiously, it's fictitiously real. Look, you can actually trade this as one unit. You can trade it as one unit. And you go, well, that is cool. Okay, it is cool. You can trade it as one unit. And you go, what do you mean it's one unit? Look, it's all one strategy. And I can hit confirm and send, fire a will. Okay, I'm filled. So my watch tells me I'm filled before the platform even does. So what, you didn't think I was going to route some trades today? Okay, where's the fun if you don't route a trade? Anyway, I did all 3 chunks as one, but you're not going to want to do that in your account. And I'm going to tell you why you're not going to want to do that. That is going to eat a proverbial crap load of margin. So what we are going to do is have you doing these, okay, in products like the MES. Now, if you're to do this in a product like the MES, guess what? Then, okay, you can break it into 2 parts. And you're going to have to understand this. And there's going to be a little complexity in here, okay? If you do this in sometimes the micros, you're going to want to break the trade into 2 different pieces. And again, I want to show you, this is 2 components, okay? But this is on Tasty. So on Tasty, there's the hedging spread, and here's the sell of the put. But it's essential to know that they do have to be broken apart into 2 separate trades, that you can't actually do this as one position inside some of the futures contracts. Okay, I like this. All right, we good? Now, I'm good. By the way, don't get panicked about the orders. People like, I run through this and this and this, and they're like, don't do this to me, man. It's too fast. Don't worry, we're gonna beat you up on this really good. All we want to understand, again, right now, what do we want to focus on right here and now? Okay, I'll tell you exactly what we want to focus on right here and now. We want to focus, okay, again, structure, logic, big broad strokes. Why is he doing this? Why is he doing this? Okay, why am I doing this? The first thing you need to grasp, and again, I always like to recap some of the concepts. The first thing you need to grasp, the inflection point spread is not something per se new to me, okay? It is something I have used to mitigate risk in extreme environments for umpteen years, okay? What is new is actually using this as what I term a come out trade. When I say a come out trade, okay, it's boom, I got the hedge on and the premium sell. I would always use these out of the money put spreads to hedge. I would always use them. Actually, it's like using a gamma iron, except a little further out of the money. But I would always use these types of trades to hedge. Again, what's new is the fact that I'm actually doing 1, 2 transactions, okay, like this. Now, using implied volatility skew, okay, to reduce the cost of a hedge. So I want you to understand structurally why this works, okay, and what I'm doing to put skew in your favor in both the hedge and the premium sell. So there's 2 components. There's a hedging component and there's a premium selling component. And I want to put skew in your favor in both. So we're intent on buying an inside hedge. And when I talk about an inside hedge, okay, we're selling way out of the money premium. Like if you looked at a distribution curve, I'm trying to get like in camera angle over here, but if you looked at a distribution curve, we're way out here selling crap. We're using an inside hedge. An inside hedge is a hedge well inside the premium that you're selling. So we're intent on buying the inside hedge. You're going to hear that phrase throughout the course of the rest of this class. It's an inside put spread hedge, an inside put spread hedge to reduce the risk of far out of the money options that we're selling. Okay. In indices and sector related ETFs, most often the put skew rises farther out of the money put options. By the way, at this point, I want to elaborate upon something. Inevitably, a question will come up, and the question is a very pertinent one. Can I do this with calls? Yes, but not in the index products. You need an inverted implied volatility skew. We'll come to that. Again, how can we use the knowledge of put skew to create a hedge and sell far out of the money premium? Let's examine skew, okay? Let's examine skew. Advantageous implied volatility skew. Implied volatility of puts, again, typically rises the further, okay, we go out of the money. Put skew is relevant in index and index related products. By the way, when I say put skew is relevant index related products, what does that mean? SPX, it's an index, spiders. You can even look at the XLF, okay? You can look at, a lot of your sector ETFs, the QQQ, the IWM, those are all index and index related products. And of course, somebody gets cute and they go, what about a futures contract? what do you think the S&Ps are? It's an index or index related product. I'm sorry. No, they're futures, man. They're not indexes. Okay. They are indices. So the futures contract, doesn't matter whether it's an S&P options on futures contract, whether it's SPX, whether it's Spider, people, it's all the same crap. Skew measures. When we talk about skew specifically, it measures the at the money implied volatility versus out of the money implied volatility in calls and puts. So let's view an option chain. Let's view an option chain and let's get into the detail of how skew can be used to hedge advantageously and sell premium advantageously. You ready? You ready? Because now you're going to get thrown in the deep end of the pool. Okay. So here we are. This is a screenshot of Thinkorswim. Okay. So if you look at Thinkorswim, a screenshot, or we could use Tasty. So you have to have, different voices for both Thinkorswim and Tasty. It's Thinkorswim and then Tasty. I don't understand why either. This is a spider. The spiders are trading this day at about 437-ish, whatever. We go right after the 30 delta. We sell something. Okay, we're going to buy something around the 420, sell something $10 further out of the money. Again, don't worry about the criteria just yet. We're going to get there. Okay. Okay. Spider. I wore a spider shirt because I knew I would talk about the spiders a lot. Really, I didn't. It was just, that was happenstance. Okay. I wore my most comfortable pajamas I could possibly find. If you're not familiar with these spiders, they're fuzzy on the inside, man. Okay. Doesn't get much better than that. Actually, my wife asked me today, she goes, don't you have a class? She's not putting on a Theo trade shirt, not doing this, not putting on a collared shirt. She goes, you're wearing your freaking gym clothes, AKA the pajamas? I go, yes. Okay. So then of course, she goes, you're going to put on real shoes? I go, no. Okay. There's UGG slippers on right now. Oh, I promise you there are, right? Do not make me have to show you slippers. Okay. You work out of your house, man. All right. That's UGG slippers. These are not yoga pants. They are not yoga pants. How do I use implied volatility skew favorably? Okay, so this trade here is the inside hedge. This is just the inside hedge. The way that we're using skew, we're buying basically a 28 vol and we're selling a 30 vol. Now, time out at this point. People look at this and they go, it's a two-point differential. 2 points is actually a lot in skew land. In skew land, 2 points is considerable. So we're actually putting implied volatility skew in our favor. And frankly speaking, you're buying really high implied volatility. I am, but I'm buying a 28 and selling a 30. So any impact of implied volatility is being negated, right? Because I'm buying, even if I was buying a 30 vol and selling a 30 vol, I've actually negated all the vol. In this case, I'm actually buying a 28 vol and selling a 30 vol. So it's actually put skew slightly in my favor. So what am I really paying for vol? I'm really paying in this case, what? -2. So I'm somewhere paying right around what the at the money options are trading for. So again, skew, if used correctly in buying a put spread, is being used advantageously. Does this make sense to everybody? Okay, sometimes the little hamster gets stuck in the wheel. So again, I'm putting skew in my favor. 2 points is a lot. Skew, okay, if you looked at present market conditions, let's just go over to present market conditions. Now I can use the MES, right? MES, what is the MES? It's the micros. So let's go into the 30 days, right? 30 days. And by the way, it doesn't matter whether I use Thinkorswim, whether I use Tasty, I'm going to go interchangeably. Okay. And frankly speaking, I've been trading on Tasty much more for these strategies. But if you do this, okay, on a trading application, look for yourself, look at implied vol. So here's implied vol. I'm buying is almost like a 30.7, right? So I'd be buying this little monkey right here. You know what? Let me delete that one for a second. Let me make this even easier. I'll do the 4140s, okay, and then sell the 4040s against it. Look at the 4040s, and those are trading for 33 vol. Dun, 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 dun. Okay, now this is trading for $20. You go $20, but look, I'm selling a 33 vol. What vol was I buying? Okay, I'm buying basically just under a 31 vol. Skew is favorable. Okay. To continue on, Then I'm going to just sell a June option against it. Is this not what I just did in the spiders a moment ago? Okay, I'm going to sell a June option against it. Look at the June option. Yeah, it's like a 40 vol. I like it. Okay, that's what skew is right now. And here's the craziest thing. What a lot of people do not realize is, and I got a lot of emails like, why are you selling options 110 days out? Because baby, that is where the skew is. Okay, I want skew, the heaviest skew right now. This was not always true. Okay, the heaviest skew right now is in back month options, and you want to be in that heavy skew. The implied volatility is above 40% on this 6 delta option. It is beautiful. In every case, in every way, shape, or form, I am putting that skew in my favor. Now, recapping the game plan. The inflection point game plan. Number one, you got to sell far out of the money options premium. That's the intent. What are we also going to do? We're going to use inside hedges, put vertical spreads to hedge. We're going to distribute capital into multiple expiration cycles and over many strike prices. Okay, we're going to manage aggregate risk using a risk array. We'll bring you into that here momentarily. We're going to close profitable trades, continue to allocate. Okay, know the strategy and game plan. Like, you got to know it. And once you do, and once you just think you have like a little bit of logic of this, now we're going to move on to criteria. We okay? Okay to go? Okay to go. We're just going to continue right on over here. Part 2, inflection point spread opening criteria. Okay, that's what we do here. Okay, this is the reason you're here. Okay, I think that a lot of you could have come up with, all right, I get it. I get the criteria he's using and so forth. I have been trading inflection point spreads now in the Theo Theta small portfolio and in the main Theo Theta portfolio for months. Okay, we just didn't really start calling them that until I started sending them out in text message. I'm like, we need to call this thing something. Okay, and that's when we have officially named it. We've officially named it the inflection point spread. Now, the criteria I've used in the inflection point spread, okay, is extraordinarily definitive. Like, it's very finite criteria, and I'm going to take you through it. The cool thing is, though, about inflection point spread criteria, it's actually pretty simple. The weird part of the inflection point spread criteria, it matters from a Reg T account to a retirement account to portfolio margin account. It differs. Not a lot of the criteria, but the products that you trade and your margin changes. Okay, I get questioned all the time, and I want to bring this, okay, right now into scope. Okay, everybody says, what can I make selling premium? It is absolutely imperative that you understand what you can make selling premium, okay, is critically dependent upon where you're trading. Are you in a regulation T margin account? By the way, some people have no idea what Reg T margin means. Regulation T goes way back into like the 1950s and 60s, specifically in the 60s, I think was the last time they actually changed even Reg T margin. Reg T margin is just a standard margin account. Then you come into retirement accounts. Then we look at portfolio margin. Portfolio margin, okay, consequently kind of means you have a big boy account. Big boy account over at Thinkorswim, over at Thinkorswim, TD Ameritrade, you have to have about $150,000 to open a portfolio margin account. Now, listen to me, I'm not here to promote, okay, Thinkorswim. In fact, I've been using Tastyworks considerably more. You can have a portfolio margin account at Thinkorswim, TD Ameritrade, Charles Schwab. By the way, they're all the same thing. Thinkorswim was eventually bought by TD Ameritrade. TD Ameritrade was gobbled up by Schwab. Who's bigger? Nobody. Okay, welcome to Walmart. Anyway, if you take a look, portfolio margin account, I think you have to have $250,000 though at Tastyworks. So it's a bigger account. The bigger account though gives you more flexibility, more buying power. So you cannot compare the returns of portfolio margin to a retirement account to a Reg T account. And I want you guys to know that because everybody always asks that question, you know, oh, how much am I going to make off this thing? And I'm like, it's a rookie mistake, man. Okay, you make quite a bit, but it depends on the account type, and you're going to see that here. So with that, step number one, criteria. Okay, step number one, selecting products for inflection point spreads. In a Reg T account, Reg T, what does that mean? Regulation margin account. You'd want to use the ES, the MES, the ZB, or the ZN. That's it right now. Like, could you expand? You're like, I want to trade oil. Yes, you could do this in oil, but I want to do it in oil now. Oil is funky, man. First of all, oil, okay? Holy crap, is that crazy right now? That's only right now. Now, okay, people of the future, I'm talking to those that are watching this on a video 2 years from now, people of the future, we're in a very weird time right now, okay, where oil is kind of expensive. I know, people of the future, there will be no oil. We're going to go green, okay? Everyone will drive a Tesla. And the crack up about that is I have a Tesla, okay, and my driver's side door handle, it broke yesterday. So I have a Tesla, I just can't get in the Tesla. So my daughter's like having to like climb through the back seat to open up the front door over there. And every time now I'm going to get in the car, I'm going to like, Elon, you know, you damn green. By the way, it's a very common issue apparently with a Tesla to break the door handle. Okay, it doesn't look broken, it just doesn't open the vehicle. Anyway, selecting products for inflection point spreads. You could do oil. I know oil is crazy right now, but I think you better understand the concept first in using a major index product, because oil would have an inverted implied volatility skew. Oil is Mr. Toad's wild ride. So in, again, a regulation T account, ES, MES, ZBZN, ES, MES, ZBZN, also a retirement account, the portfolio margin account. Yeah, listen, man, you trade anything you want. Just go to town. Products listed are intended as a guide and are not limited to the aforementioned securities. Okay, I've been doing this long enough now that I know one reality. Here's the reality. I will put exactly what you should trade initially in here. No one will listen. You don't give a damn. And you're like, I'm going to do this in GameStop. Okay. I'm hoping that, okay, that changes for some of you. Are we ready to move on to step two? Because step two, okay, this is going to get a little crazy here with step two. Okay. So step two, constructing the inside hedge. So by the way, this one, I just went for it and like building the criteria. I'm like, you know what? You guys were supposed to watch the Ultima class before coming here. So screw it. We're just putting all the criteria packed into one nice condensed slide. I like it. Okay. Constructing the inside hedge. What's an inside hedge? It's the hedge. It's buying the put spread. In order to build the inside hedge, the following criteria it's like mission critical crap. Select an expiration cycle, 25 to 35 days remaining. Now, okay, listen to me very carefully. Don't screw this up. I'm going to go 50 days out. If 25 is good, 50 has got to be better. It's not. You don't want to do that. You need the shorter duration options. You go, well, why? Because I need the bang, okay? I need the gamma. What's the gamma? Bring gamma out here. Okay, no, not that. Bring gamma. Gamma is the rate of change, okay, of the delta. So if you delta, the rate of change of the option for every dollar move in the stock. I don't need that, but I need gamma, okay? Gamma is the rate of change of the delta. I need a lot of bang for our delta buck. And we're buying way out of the money options. We're going to use it as a hedge, okay? So hopefully we don't have to use the hedge. And I want to make that clear. You know, why are we buying a hedge? Sacrificial lamb, okay? Once a month, you will throw a lamb into the volcano, okay? Why do we do that? Because we do not want to piss the volcano off. We just throw the lamb into the volcano, okay? Do we ever have to use it? Periodically. I've had to use it a lot lately, okay? But we hope to just throw the lamb into the volcano, never to see the lamb again. You're like, that seems like a lot of money to pay, but it's not for the kind of coverage we're getting. So select an expiration cycle 25 to 35 days out. Now, let's go to a trading application. We got a trading application. And here's the fun part. I'm going to use spiders. Then I'm going to go to the MES. Then I'm going to go to the ES. And I'm going to go this way and that way. And I'm actually going to show you on different platforms. See, I like doing this. First of all, I think I like to torture people. So you'll enjoy that. But I want to explain you something. Different products have different expiration cycles. Here we are on Tasty. Okay, Tasty. So again, everything has to have its own voices, right? There's Tasty. If you take a look, 25 days. Ready? This one? We could use this one. We could use this one. We could use this one, this one, this one. Any of those expirations will work. Is more better? Is further farther? Is farther further? Okay, I don't know, man. If between 25 and 35 days, okay, if you're like, an engineer out there and you feel the need that you haven't taken your medication, okay, then so be it. Anyway, you can open up the 30-day expiration here. Then, why don't we go over to MES? Here's the MES. These are the micros. Okay, which expiration cycles would work with micros? The reality of the micros? Only right here. Whoops, swing and a miss. Really, there's a 24-day. It looks a little short. But you can see I've actually got something on in here. Ooh, what does he have on? Something special, something spectacular. Anyway, you're pretty much limited to this little monkey right here. What's going to happen? You're going to hit some weird points in time where it's like there might not be a 25-day and there might not be a 35-day. You're going to have to make do. It happens. Okay. I'm trying to give you the best construct possible, but I'm telling you right now, okay, people of the future, listen to me. The micros are a little weird. They don't list a gazillion different expiration cycles in the micros. They don't list a gazillion expiration cycles. So some days, like 6 days from now, this 30-day option is going to be the 24-day option. 6 days from now, this 44 is going to have like 38 days. You go, oh, one of them doesn't even fit the criteria. That Don guy, he screwed me. Okay, I know what you're thinking. You're sitting at home. He screwed me. Okay, listen, you can use like the 36-day or something to expiration or 38-day to expiration. It will happen. Okay, it will happen periodically. But anyway, I wanted to show you that. Then I'm going to cruise over here, okay, just to the S&P options on futures. On the full S&P, right, this little guy's got 1 million expirations. This will work. Okay, so you have 3 different expiration cycles that'll work here. We good? Okay, that's what I mean by time to expiration. And again, next, I'm actually going to cruise. I'm going to cruise from like Tastyworks back over to Thinkorswim, back to Tastyworks, from the MES to the ES to the S&Ps. Okay, I thought about this stuff, and I want to make sure that you guys understand exactly where we're headed with this. Okay, okay, continuing onward and onward and upward here. So again, 25 to 35 days out. Select the long put strike in a delta range from 28 to 33. Okay, -28 to -33. Did you know why it says -28 to -33? Because delta on a put is always gonna be negative. So long put strike, delta in a range from 28 to 33. Let's go find that. Let's go find it. Back to the trading application, but this time we're going to Thinkorswim. Okay, so let's go to the MES. In the MES, where's a delta range of about what? From 28 to like 33. Oh, I could use this one. I could use this one. I could use this one. You know what? When it says a delta range from 28 to 33, what's kind of in the middle? 30. You're a winner. And you go, this is not perfect, man. Again, there's medication for that. Apparently, you're not on enough of it. But the 4150s, good. Take them. You're not going to buy those yet. Just calm down for a second. So we look for the long put strike. It's pretty easy. So 25 to 35 days, we're 30 days out. We're using a 30 delta. In the spiders, QQQ, and IWM, make the put spread $10 wide. Here's something interesting, okay? I ran all this regression analysis because I was worried, like, what happens if we use the spiders, which is $400 versus the IWM, which is $200 versus the QQQ? The law of price right around the same. Make the put spread about $10 wide. In the MES and ES, make the put spreads $100 wide. Ooh, crazy, right? Okay. Inside hedging spread will price from $1.60 to about $2.25. okay, in SPY and QQQ, IWM. It'll trade from about $16 to $22.50 in ES and MES. If the spread does not meet the following criteria, how about this? Don't proceed. You've either screwed something up, okay, or the market is in such an excessive or such an extreme that it simply will not fit. And I've actually now, I have done a little bit of regression analysis to find out that in the most odd cases, this may not fit the criteria, meaning that there could be an instance, right? There could be an instance where we actually run into a blockage, if you will, in the criteria. It would have to do with a change of the skew, but it's possible, it's plausible. It would just be an incredibly rare event. So here we are. We're actually going to initially build this in SPY. As I said, I'm going to use the products interchangeably. Spiders, MES, ES, IWM, QQQ. It's all the same animal. Okay. I mean, yes, the IWM is different, but they're the same animal. So I could go into the March 31st. I could even use the April 1st. Look, there's 31 days. Oh my. Okay. Here, I already placed this one. So let's go actually look at it. So why did I place this? Well, first of all, it's 30 days out. Okay. Next thing I do is I kind of scrolling. I try to find something right around like a 30 delta. And notice I used a 31 delta, but don't freak out on me. I mean, could you use a 30 delta? Yes. Just buy the 414s. Why? Because they're 30 delta. If I buy the 414s, I want to go $10 wide out. So I go to the what? The 404s, click on those. 208. Timeout. Does that fit the criteria? We have a $10 wide spread for $2, let's say, and 9 cent or $2.08 debit. Does that fit within the criteria ranges? Yes, it does. You may proceed, but let's do it again. Let's do it again, but this time, let's do it in a big boy product. Let's cruise over to Tastyworks. In Tastyworks, we're actually going to use the S&P options and futures. I type in the full S&P options and futures, not the micros. Type in the full S&P options and futures. Let's go 30 days out, okay? Or in this case, we can get even crazier. We can go 31 days out. You know, listen, I just want to show you that it'll work in different expiration cycles, okay? So I go exactly 31 days out. I go to right around the 30 delta option, 4150s. I'm going to buy the 4150s, but in a product that's this large, I would do a $100 wide spread and sell the 4050s against it. Okay, sell that little monkey. It's trading for $20 and what? 50 cents. If you look at one versus the other, here's one spread. Look, this one's actually trading for 205. 205, okay, $20.50. Is there a difference? No, not really. Okay, it's just a multiple of one another. Just wanted to throw that out there for you. So both of those would work. Suffice to say, we're happy. Are we okay? Okay to go? Okay to go. All right. All right. So if the spread does not meet the following criteria, okay, do not, okay, move forward. All right. There's ever proceed, precede, okay? Do not move forward, huh? You like that? Oh, I'm going to change it in the slide deck right now too. I love this. People go through her typos, the typos. I know it's your job to find it. Like, I am an engineer. This is what I do. Okay. I am an FBI agent. Yeah, the acting is almost as good as Keanu Reeves. Okay, do not, watch this, move forward. I can't type. I'm sorry. All right, my keyboard is a little further away than I had anticipated from the screen over here. Okay, does that help? Okay, does that help? All right, leaving the Canadians alone right now. The spread doesn't meet the following criteria, don't move forward. It will, and again, in the vast majority of the cases, it will actually work out beautifully. There are a few instances where it may not fit that construct. Just for argument's sake and for some fun, I'm actually going to cruise right now over to the QQQ, because where I found things can get funky, and I'm not joking, where I found things can get really funky is if you were to do this in the QQQ. And IWM, there's some really extreme volatility right now in these products. And the more the extreme the volatility. So here we are 30 days out. We jump to about a 30 delta. Okay. Buy the 329, sell the 319s, done. 217. Boom, it fits. but it's on the higher edge. You know why it's on the higher edge? Because the volatility is a rocking in that product right now. The QQQ is a $345 product. Then he switches to IWM. He goes to IWM. Again, these are the products that'll give you some nightmares, okay? The products like IWM is trading at just a rocking volatility. Well, I could do the 191, but look, if I do the 191, there is, okay, no 181. So I have to delete that one. You go, oh no, it doesn't fit the criteria. Okay, go to the 190, 180 spread. Okay, boom, $1.89 fits. Okay, it'll fit. Just calm down. Calm. Be rational. Fits the criteria. So now, step number one, we went through, we selected a product, the MES, the ES, okay, the spiders, the QQQ, the IWM. I'm not going to the SPX. Okay, I will not go to the SPX. All right. So I did not wear the ribbon. All right, continuing on over here. Step 3, selling an out of the money put. This is ultimate criteria. Now, there is one caveat in the ultimate criteria. Sell 60 to 115 days. I put the 60 to 115 days. Why 60 days out? Because people are annoying me and selling short dated premium or shorter dated premium. So you just bump that out a little bit there. Anyway, 60 to 115 days. Do not go more than 115 days. There's too much volatility risk. I mean, listen, if it's 116 days, I go, you a naughty monkey. You can do 116 days, like seriously, don't worry about that. But when you start going much further than that, like you start going 120, 130 days out, don't do it, okay? Don't do it. The options are not fairly priced when you go that far out in time. So sell a put between a 6 and 10 delta. Me personally, okay? I use 6 and 7 delta puts exclusively, okay? I give you a range. And the reason I give you a range is because I want you to be able to build more of an inventory, you know, a little bit here, a little bit here, a little bit there, like to actually spray some inventory out, okay? Do not execute the sale of the put until the hedge is in place, okay? I have been in a situation where I have sold a put naked, and literally within 5 minutes, I went to hedge and I'm like, oh man, I'm getting screwed. The market's collapsing right now. Hedge, sell put, or do it all in one transaction. Review allocation prior to selling out of the money put. Where's the allocation section? There's an allocation section. Don't worry, it's coming. Okay. Don't you worry about a thing. So if I were to sell a put right now, and let's go into the SPY. If I was going to sell a put in the spiders right now, I go 108 days out, scrolling, keep my chickens scrolling. Yeah, that one works. Apparently I already sold it today. I could sell this one or this one or this one or this one. I could sell any of these. Okay. I could sell 340, 325, 310. I could even go to the 305s, right? There's nothing wrong. Or I could close up the June and I could actually use May. There's still 80 days left in May, right? So could I use a 6 delta put in here? Look, apparently I've already covered a whole hell of a lot of those. So the answer is yes, I can. So not only do I talk about it, I apparently sell them too. So you could use those. So let's cruise over then to the MES. And be careful, okay? In the MES, there's a lot less expirations to select from. 108 day, 91 day, 80 day. Frankly, I don't trade MES. I do not trade the MES on anywhere but Tasty. Why? It's better. The margin is better on Tastyworks unequivocally. They don't let you do what you want on Thinkorswim with smaller accounts. Okay. So here, when I'm looking at this, which expirations would I use? I would probably use this 80 day or the 108 day. That's it. Okay. Look, I already have positions in here as well. So I'm allocating a little bit here, a little bit here, a little bit out here. I'd go probably the 108 day. Volatility is elevated. Look at this. We're in almost a 32 VIX. Bring the pain, man. This is awesome. You know, whenever you plan to do a class like this, okay, when you plan to do a class like this, the point of the class is that you need to be able to hedge in an extreme environment. Does it get more extreme? Okay, you're trading in a 32 VIX, okay, and it's off the high of the day. It was actually at 32.50. So you have to realize like it doesn't get better than this because the hedges are still working. So consequently, this is exactly what we want for argument's sake in the class. So here, if I'm all the way out in the June expiration, look at these 6 deltas. I mean, we're all the way at the 30.50 strike, people, but 30.50. Could I sell those? Sell them. Beautiful. Now, okay, we've hit the perfect point. Before we actually jump any further today, we've hit the perfect point to take our first break. And because we're going to move on to step 4 here momentarily. And I'm going to tell you right now, we get to step 4, it's going to get a little bit serious. So bear with me here for just about 5 minutes or so. We are going to take our first, albeit brief break, and we'll kick this off in just a few minutes here with part 2, of course, of the inflection point spread course. Stay tuned.